All right, let's jump right into this explainer. We're going to uncover the unseen matrix of money moving, reacting, and being tracked all around you. Whether you're day trading stocks, analyzing a massive corporate balance sheet, or just tapping into your own home equity, there are hidden ledgers and unseen forces that are really dictating the true flow of capital.
So what do drug cartels, corporate accountants, and the IRS all have in common? I know, it kind of sounds like the setup to a weird joke, right? But seriously, let's dive into this bizarre connection. To truly understand global wealth, we have to look way past the visible banking systems we use every day. We need to explore the absolute bottom of the iceberg, the mechanics of shadow economies, complex accounting illusions, paradoxical market reactions, and finally some brand new surveillance rules targeting personal wealth.
Layer 1, the deep underground. We're going to look at the mechanics of what's known as flying money. We're starting way down in the criminal underworld. We're talking trillions of dollars moving globally between cartels and brokers without a single cent ever physically crossing a border. Authorities actually call it flying money. It is absolutely fascinating how a centuries-old solution for carrying heavy copper coins evolved into the ultimate modern shadow banking system. Back in the 8th century, Tang Dynasty tea merchants invented these paper mirror transactions just to travel safely. Fast forward to 2017, when China limited capital flight to $50,000 a person. Wealthy individuals, desperate to move their money offshore, fueled a massive explosion in modern underground banks. And today, in 2026, highly trusted global diaspora networks use those exact same historical principles to transfer unimaginable wealth without touching a single traditional bank.
Okay, let's visualize how this actually plays out today. Picture a hypothetical wealthy investor in China, let's call him Mr. Chen, and he wants to buy a gorgeous apartment in Miami. Meanwhile, a cartel in Chicago has $2 million in dirty cash sitting around that they desperately need back in Mexico. Mr. Chen gives his clean money to a broker in China. Over in the US, the cartel drops their dirty cash with a connected US broker. Then, the two brokers literally just message each other on a secure, encrypted app. Mr. Chen's relative in the States is handed the cartel's $2 million to go buy that Miami apartment. Boom! Zero funds crossed a border. Mr. Chen gets his real estate, the cartel cleans its cash, and the brokers just balance their ledger later.
But wait, eventually those ghost brokers have to balance their own books with each other, right? They don't just wire the money. No way, that leaves a trail. Instead, they manipulate the global supply chain. They secretly hide immense value inside super mundane trade invoices. For example, a cartel front company in Mexico might purchase $10 million worth of refrigerators from a broker's totally legitimate-looking factory in China. But if you look closely at the invoice, it's doctored to only show $8 million. That hidden $2 million difference? That is the phantom ledger being settled. It is virtually undetectable.
To put this all into perspective, we are talking about roughly 3 to 5% of the entire world's GDP. That is $4 trillion of illicit proceeds literally flying above our heads undetected right now. It's an entirely separate financial matrix operating completely parallel to ours.
Moving on to Layer 2, corporate shadows. Let's unpack the deferred tax illusion.
Surfacing a bit from the underground, we hit the corporate world. Here, companies use perfectly legal but mind-bendingly complex accounting maneuvers to obscure their true financial obligations. Just like cartels hide money in trade invoices, corporations hide future liabilities deep in their balance sheets. If you're analyzing a business, understanding how they prepare for the future is absolutely crucial because, well, taxes are one of life's absolute certainties. International Accounting Standard 12 governs this concept of deferred tax. It exists for one simple reason. The way a company reports its profits to its shareholders is often wildly different from the way it reports its taxable income to the government.
So, here's the critical difference you need to grasp. Current tax shows what a company actually owes the revenue authority right this second. But deferred tax, that reveals the hidden future burdens that will eventually drain cash from the company down the line. Think of it like a financial ghost. It's a liability that hasn't materialized just yet, but trust me, it inevitably will.
Why does this matter so much? Well, if you only look at current taxes, a company might look incredibly cash-rich today. But lenders and savvy investors rely on this specific deferred tax metric to ensure a business isn't going to just suddenly collapse under a mountain of unseen future tax bills. Cash is king, right? And deferred liabilities directly dictate a company's future liquidity and its capacity to service debt. If you miss the deferred tax, you are entirely missing the company's true valuation.
Layer 3, the market paradox. Basically, when oil burns, gold freezes.
All right, surfacing even further to the open markets, we had a fascinating paradox that literally blindsides everyday retail investors time and time again. The financial matrix behaves in deeply counterintuitive ways during a crisis, largely because of the unseen institutional mechanisms pulling the strings behind the scenes. Think back to the conflict in February 2026. The Strait of Hormuz was blocked, and 20% of the world's daily oil supply just vanished overnight. Brent crude jumped 13% to $82 a barrel in a single day. Naturally, you'd assume gold, the ultimate safe haven asset in a crisis, would skyrocket. But the exact opposite happened. Gold actually experienced its steepest weekly decline in 40 years.
There's actually a very mechanical domino effect behind this. It happened in 1973, 79, 91, 2022, and yep, again in 2026. Here's how it plays out. Step 1, a massive oil shock triggers rapid, terrifying inflation across the entire supply chain. Step 2, the Federal Reserve panics and aggressively hikes interest rates to try and cool the economy down. And step 3, gold, which pays you exactly 0% interest to hold it, crashes. Why? Because its opportunity cost just became way too high compared to those newly hiked climbing bond yields.
But the hidden drivers go even deeper than that. The sovereign wealth funds, the big petrodollar states in the Middle East that usually buy massive amounts of gold, they are suddenly cut off from their oil shipping routes. They lose revenue and completely halt their gold purchases. At the exact same time, the broader stock market is crashing, which triggers margin calls for leveraged traders. To survive those margin calls, institutions are forced to liquidate their winning assets, which means they have to sell off their gold just to get their hands on cold, hard cash. This overwhelming, multi-layered market fear led to an absolutely wild statistic: a 100% SIP stoppage ratio in March 2026. This means the number of retail investors halting their systematic investment plans entirely matched or exceeded the number of new ones coming in. Everyday people completely halted their mutual fund investments in a state of sheer panic.
So the major takeaway here? The market is always going to face cyclical shocks, whether it's an oil crisis, a pandemic, or inflation. Reacting to short-term fear absolutely destroys the long-term compounding required to build actual generational wealth. Missing out on consistent investing because of temporary panics is exactly why 99% of retail investors fail to generate massive, multi-decade returns. The institutional money understands the paradox. The retail money just panics.
And finally, layer 4, the personal trap. We're looking at the May 2026 IRS senior rules.
We've reached the very tip of the iceberg, and this one is right in your own living room. The unseen financial matrix isn't just about shadowy cartels or massive hedge funds. Starting this month, May 1st, 2026, the financial privacy older homeowners previously enjoyed when tapping into their house's equity is officially a thing of the past. A massive, unprecedented data gathering initiative has just kicked off, specifically designed to close billions of dollars in uncollected tax revenue gaps. The IRS is now mandating that lenders directly report 3 very specific transactions. We're talking reverse mortgage lump sums and monthly payouts, home equity lines of credit for anyone over 62, and primary property sales. The government is now getting this data directly from your lender, which generates automated audit flags before you've even filed your tax return. Let's break down exactly where people are getting caught. Imagine you bought your home for $85,000 decades ago and you're selling it today for $680,000. Even with a $250,000 tax exclusion, you're sitting on a massive gain. Now, say you made $150,000 in improvements over the years, but like most people, you lost those 30-year-old receipts. The IRS algorithms will absolutely not give you credit for that increased cost basis. Without those receipts, your taxable gain jumps from $195,000 to a staggering $345,000, triggering a completely devastating, unexpected tax bill.
But honestly, the real danger is the unseen domino effect that follows. Your lender reports a large home equity withdrawal to the IRS. Even if that money isn't technically taxable income, it raises your perceived overall cash flow. This can easily push you over the combined income threshold, causing up to 85% of your Social Security benefits to suddenly become taxable. And then, the kicker, 2 years down the line, that perceived income spike permanently spikes your Medicare Part B and Part D premiums under the IRMAA rules. It is a completely automated, incredibly tightly wound web of financial consequences.
From cartel shadow banks settling multi-million-dollar phantom ledgers, to the unseen deferred tax burdens of global corporations, to the paradoxical institutional forces that crush gold during a crisis, right down to the automated IRS algorithms flagging your own home equity, the global matrix of money is constantly adapting. It's watching, it's reacting, and it's systematically closing the gaps, leaving us all to wonder. In a world where every single transaction leaves a digital echo,
What will financial privacy even look like tomorrow?